A little bit of data analysis quick. What I'm looking at is GLD. Okay. What I'm looking at is changes in open interest, like drastic changes, like big changes in open interest would symbolize that big institutions are joining. Maybe just one institution, to be honest, because it's a coordinated event, unless they talk to each other or something. What happened on these big days, and what happened shortly after these big open interest changes, and then we can kind of see what their thought process was, perhaps. So as you can see on here, this trend, these little trends here, you can't really see. There you go. All right. So as you can see here, the thick part is the open interest. Obviously, there's blocks of orders, and the expirations on are these separate, two separate ones. Okay, and you can see that the open interest is heavy here on strike 175 for the 11/17, November 17th expiration, and it was nothing until boom, it happened. You know what I'm saying? So it was nothing. This one was nothing until boom. There was a lot of orders here, or a lot of open interest. So overnight, this accumulated a ton of open interest. Same here. See how it's a rectangle? There is no trend upwards, gradual trend upwards, for open interest. This was just one large position, like a hostile takeover. Boom, and they have it. They have all the puts or all the calls or whatever. Okay, and the same thing happened with 195. 195 was half in, and then the next half, boom, and they happened in literally day events, one day, and it just so happens that all of these big increases happened on the same day. So 175, so the strike 175, 185, and 195. All of these big increases that you see just all the way up happened on the same day. That means the prior day was hanging at 1,000 volume or open interest, and then boom, there's like 75 grand or 100 grand. And I'll show you actual numbers here right now. So this data spreadsheet is just 175, 185, and then 195. That's what's highlighted right now. Day 42 to day 43 is when it happened, which in human terms that would be September 20th to September 21st. So actually happened on September 20th, because open interest posted at the end of the day. So September 20th, boom, that happened. So September 20th was 175 puts and calls, all right? And we'll figure out if it's a call or a put that was bought, but it was 6,000 open interest to boom 42,000. This one was I think that's 195, something like that. Yeah, 185 strike was 2,700 to 78,000. I mean, this is enormous, like, increases, and this is a lot of money on the line. Lots of money on the line. And then this one was hanging out at pretty good volume, 51,000. But then it doubled to 117,000. So I still would qualify that as a very large increase. And it increased day 7 to day 8 also. Day 7 to 8, day 8, from 3 grand to 53 grand. So someone literally bought 50,000 or entered 50,000 yeah, contracts of 195 options here. And you can see, look at the put call percent put. This is how I know that they're all puts. And we can see that from the options chain, but um these two, 185 and 195, they're 99% calls. All right. This open interest, I can agglomerate them together and then I just get the ratio and then I can see what generally happened. And more often than not, literally it's all, they don't even try to mask it with puts and calls. They literally just only do the calls if they're going to do the calls, you know? So it's 99% calls, 185 and 195, but then 175 are mostly puts. All right, this one's a little bit more even, but the day change from 6,000 to 40,000 was day 42, and you can see that the puts change from 10% puts to 85% puts. So you tell me what happened that day. I mean, obviously, from what I can deduct, is that all of those were puts. All of them. If not, yeah, pretty much all of what happened that day were puts being entered and written. So, what does this mean, though? What does this mean? So, 175s, all puts. A bunch of puts at 175, a bunch of calls at 185 and 195. Let's look at the price chart. So, what does this mean, though, right? So, day 42, it just so happened was a big high, okay? A hammer candle down, big high. This was, day 43. No, this was 920, so this was day 42. That's wrong. 42 to 43. Anyways, this is the day that all these options had made it. So this big up move during the day and then came slamming down and it's about to go down. So what happened that day was, let's plan this out. The 175s were written, 175s, and this were calls or puts. These were puts. 175 puts and then 185 and 195 calls. So let's look at this. Green. And then 195s. Way up there. Holy crap. All right. Let's see this here. So boom, it went up and down, and then this is the day that these options were entered. So obviously you'd think like, oh, they're buying puts at 180. So 185s and 195s, they're calls. So maybe they're selling these calls. I've come up with my own theory after looking at this anyways, I think that these are market makers. These aren't necessarily institutions out to make money. I think market makers, I think these are the market makers, because if they were selling these 185s and 195s and they knew what to do and make money, why weren't they getting out at this bottom? They didn't get out. They didn't get out. Like day 51 through day 54, that's in the spreadsheet. And you can see clearly, and it only goes to 60 days, okay? These little charts, it goes to 60 days. And day 51 through 54 was this market bottom here on GLD. So why didn't they exit their positions is my opinion. Wait a second. 175 might have exited. Wait a second. And that was the only one with puts being written. Let me see here. Hold on. So 175s went from 6,000 to 42,000 open interest in this top bubble. That all puts. All right? So about 36,000 puts in one day. And this is not a coordinated event. This has to be one. I I think one institution purchased a shit ton of puts. I think that's what happened. Anyways, and then the volume, I want to see 51 through 54. Look, no, the volume's still the same. It went from 40,000. It only increased in put value, so 54,000 open interest by day 60, and day 60 is around here. So these 175s, no one exited, and they still haven't exited. I can look right now. 175s, puts. Yeah, they're still there. It's 57,000 open interest. They haven't exited. They've only increased their put positions. So I don't know what they're doing here. Maybe you see this range. Maybe they're selling calls and selling puts, but they were under the weather here for a long time. Maybe that's why it V-bottomed quickly, but still, I don't know what they're doing. And this data is telling me that they entered all these positions here, which is in the middle of the range. That's actually a good idea. It's at 180. When dealing with options, that's actually a really nice entry price to be in the middle of the range if you're trying to do some type of condor. And maybe that's what was happening. But if they're selling that many, I just can't imagine. Look. When you look at it, be realistic. Being realistic here, look at the open interest ahead of time. 2,700, 2,600, 2,755, but then it jumps to 78,000. If anybody's gonna buy that many in one way, say all buying, that would drive price upwards to find sellers. It has to. You can't. No, there's not 78,000 sellers at that price. You have to keep on searching for sellers. If you're buying, buy. There's not going to be anybody at that price. So I think they're going to have to pay a huge premium if that's what's going to happen. And I don't think that's what happened. We can look specifically. Day 42 to day 43, so 920. We can do volume profile and see what happened. I'll do that. Fine. 1117, 185. Okay, 920. But I'll tell you what I think happened. This is what I think happened. They're taking both sides of the position. They're a market maker. And this is what they did. So market makers have different strikes, and that's their bank. So when they need to store some contracts in the bank, so they can disperse them when they need liquidity. When there's no liquidity there, what's the market maker's task? Is to provide liquidity, provide a bid-ask spread, provide the users a bid-ask spread, and that's what a market maker does. So why would the market maker play on one side? They'd play on both sides. What happened was here, they bought 75,000 shares. And they also wrote 75,000 shares. So they're contracts, whatever, right? So they're short and long. They're net zero. It doesn't matter. I don't think it matters. But with options, if it goes below the sell point, you're on the hook. So I think you're on the hook for more than the premium. So I think it's not actually net zero with options. With futures, it would be. But because it's a contract, you're unlimited risk on a sell option. But you're limited risk on a buy option. So I don't know how they're going to handle that, to be honest with you. Maybe that's why they doubled their calls and puts. I don't know. But what I think happened was they bought and sold at the same time. And they're just loading their bank of 185 calls. Like, they just got a bank now. They got a bankroll. Now they can disperse it whenever liquidity is thin. They can start dispersing it in bid-ask spread on both sides. On both sides, they can disperse it. And that's what I think would happen. So, and they know that people are attracted to the 5 mark, and that's where the liquidity is. 185, 175, 195. Boom. It's that simple. And I think that's what happened. They needed liquidity there to disperse. Look at how evenly this spread is spread out. Like, this is in the middle of the range, and then they disperse. Boom, they disperse. 1, 2, 3 on the same day. This market maker did that. On the same exact day, they disperse that many damn contracts on these significant strike prices. What I think happened was they're just loading the bankroll to be a market maker. They're just doing their job. And I don't know at this point if we can gather a direction from this, because as traders, we obviously want to find direction to give us a helpful hint for the next day of trading or whatever, or the next week of trading, whatever it is. 185s. All right. So I'm just gonna look at this. Hold on. 185s. I'm just gonna look at the actual day and where the volume took place, because if they were chasing price downwards, that would make sense. If they were selling all these, and then this was all these were all calls. Okay, 185 calls. I'll take a look at 185 calls, November 17th. 185 calls, November 17th. All right, let me just show this chart or screen, whatever. Let's put it on the chart here. 1 minute, yeah. I need to find the chart here. All right, so all right, what happened on this day? This is the option chart. All right, this is the actual QQQ, right? Or sorry, GLD. This is the actual option, or this is the actual option, and this is the price chart. Okay, so this is the options price chart. What happened was we see the huge volume right here. What was this volume? 73,000 in 1 minute. All right, you tell me if this was a coordinated event. 73,000 volume on options is insane. 73,000 in 1 minute is even more insane. What happened to price during this time? What happened to price? All right, 185 is right up here. Right here. This was 185. Boom. This candle on the options chart. It really didn't move much. Like, it moved up a little bit, but generally they're kind of chilling. All right, what happened was, look, this volume can't affect these candles. This volume happened within this minute. All of these shares traded hands in 1 minute. And price did not go skyrocket. Price moved 2 cents. All right. What happened was, paints a perfect picture. The market makers on both sides, they buy and sell to themselves, and that's why price doesn't have to move so much, because they're just writing a contract at 174 and they're buying at 174. They're just doing it to themselves. So, and then when their automated systems buy and sell at the same time and at the aligned price, they're already aligned, and the actual exchange just has to see, oh, this is cool. There's a buyer and there's a seller, an agreed upon price already. Boom, we'll match you, match you, and then you match 75,000 shares in 1 minute. That's what happened. 73,000 shares. That's what just happened. Now, how does this tell us what to do? I don't know at this point, because the market makers just didn't seem to dump any of their shares. So they acquired all these. Now we have an entry point. We have the market makers entry point. Now where's the exit point? And for us to know what the market makers are going to do or doing whatever, we have an entry point. That is my assumption. 100%. That's my assumption. That's an entry point. But look, they held on to their shares. They're held on to all of them right now. They're still holding on to 185s, 175s, 195s. And price has moved substantially. Price was way under all of these strike prices. And if they were smart, they could have gotten out of their puts. They could have gotten out of their sold call positions all the way up here. They could have gotten out of their profitable positions here and then let it turn around. But I don't think the market makers are here to make money. This is my deduction from this. If they were, then why didn't they get out here? Right? Like, why didn't they get out here at this bottom? They didn't. They're still holding all of their options at this bottom. Past this bottom, they're still holding it. Current day, they're still holding all those options. So I don't know when they're supposed to release release it all, but I don't know if they will. I don't know. I think they're slowly buying and selling to have a bid-ask spread at these strike prices way up here. But even if that's the case, I just don't know. I don't know. I don't know. I don't know if they're here to make money or not. Or this is their trade. What? Maybe their trade is a condor. I don't know. I don't really know. I don't think they're trading. I think the market makers are there just to provide that liquidity and as a thank you. I don't know how they get paid then. Maybe they're not allowed to make so much money and they're only allowed to make the little bid-ask spread. Like they acquired them all those options at between 172 and 175. So net, they're selling these options wherever it needs liquidity. It doesn't necessarily happen at 175 or 174, you know. It happens anywhere, 150s, wherever the option price is now, you know. Right now, down to 145, right? Like, that's all where the market maker can start dispersing these shares. And it's not just they bought, they sold and they bought. So they have abilities to sell these calls, and they have the abilities to buy these calls when they need to. So it's they have both banks. And whatever needs more liquidity, if people are buying more, then they can sell more of their calls than get out of their longs. So you can do that to provide liquidity. But if they're gonna provide liquidity, I don't see any direction. Like is this happenstance that on the highest bar of this huge down move, of this aggressive down move, which is a lot of money, from 180 to 170, 168. This was an aggressive down move, just straight down, and their options entered at the top. But like I said, they're not going to be able to get out of these positions. They need to be able to get out of these positions, and we need to see that open interest decline. And we have not seen it yet. So I would expect them to liquidate at least something here, and they did not. I didn't see anything. At least from those big options that we see, those big accumulations, we haven't seen the liquidation at all. So we're still waiting on that. We have a couple weeks until expiration for these options. So I don't know what they're going to do. I don't know. But I think we have identified a entry for the market maker, but we have not identified an exit point for this market maker yet. So at this point, it doesn't actually give us any direction. It just makes it known that, hey, probably use these strike prices because they're high open interest. I mean, that's the only thing we can deduct from here right now. So still, we're gonna watch over these open interests and see if they fluctuate, see if there's a big down move or whatever in open interest, and then whatever direction that down move happened, we can assume that they're getting out of one side of those calls, whatever. So yeah, that's the plan. Market makers, man.